over a month ago, we dreamed up the Cramer Covid-19 Index, a list of 100 stocks that seemed perfectly positioned for the pandemic economy. We created the index over the weekend of April 25th and debuted it on air the following Monday. So how's it done? Well, April 24th to May 22nd, COVID index first 4 weeks, it performed pretty well, but it could be better. In those last 4 weeks, the Cramer Covid-19 Index gained 96.5%, trouncing the Dow Jones Industrials up 2.9% and the S&P 500 up 4.2%. It's good to be beating the two most important benchmarks. Unfortunately, our COVID index is now trailing both the NASDAQ Composite, which is up 8%, and the NASDAQ 100, which is up 7.1%. While our index has plenty of tech, it doesn't have as much tech as the NASDAQ, and tech's been on fire. In addition, over the past week, our COVID-19 index has fallen behind the small-cap Russell 2000, which is up nearly 10% in the past 4 weeks. That's incredible. That whole gain came in the period from May 13th to May 22nd, when Russell exploded higher. That really wasn't something I anticipated. Got that wrong. I figured this would be a tough period for smaller companies. That's truly changing since we started getting some positive news on the vaccine front. As we reopen the economy, many of these smaller operators are getting to be in better shape, certainly better shape than a lot of the economists said they would be. And that's why after the first 4 weeks, I wanted to review the COVID-19 index performance in more detail and then make some adjustments, because the whole point of this list is to be a distillation of what's working right now. When you break the Cramer Covid-19 Index down by sector, the best performing group is the financials that work, up 22%. Cloud software comes in second, up 18%, a little weaker today. Behind those, you got the semiconductors and the exotics. The semiconductors, some China, some not. A catch-all category for the exotics is a bunch of weird companies, both up 11. Then we got high single-digit gains in the beverage stocks, e-commerce, gaming, home entertainment, mega-cap tech, regular tech, and the restaurant survivors, the ones with enough digital exposure to thrive here. On the weaker end of the spectrum, the retail survivors were only up 1.5%. The biggest underperformers, though, the safety stocks with big dividends. Consumer packaged goods plays, packaged food, utilities, and the more defensive real estate investment trusts were all in negative territory. It seems to think that people don't think we're going into recession. The weirdest group, healthcare. We put 20 healthcare stocks in the Cramer Covid-19 Index, making it the largest sector by far in this equal-weighted index, and on average, the healthcare stocks were flat. But that average has a ton of variability. We've had some huge winners. Dexcom, that's the diabetes, their glucose monitor, that surged 22%. Massimo pole vaulted more than 18%. I check my blood oximeter every day. AbbVie rallied 10%. That's the close of the Allergan deal. Then some middling performers like Perrigo, Thermo Fisher, Zoetis, a bunch of names that were pretty much flat. Regeneron, Pfizer, ResMed, United Health Group. And by the way, I think Regeneron's a real buy on that print at the end of the day here. That's the selling of Sanofi. Then a series of losers with the worst performance. They're some of the best American companies. Johnson & Johnson, Eli Lilly, Gilead, Centene, and Becton Dickinson. Latter's down almost 11%. I think it's no coincidence that some of the weakest performers in healthcare were also the most defensive. Market lost interest in well-run, big pharma plays with bountiful dividends like J&J or Eli Lilly. Shame on the market, but that's what happened. For the whole index, the best performers should have come as much of a surprise. You got Peloton, because their machines are essential if you can't go to the gym. You got Livongo Health, which is like a digital personal health company. Coupa Software. So these stocks were really down today because these are all new economy. Cloud-based platform that helps businesses handle expense management. Huge in an environment where millions of people want to get reimbursed for setting up their home offices. Spotify snuck on there because it's rolling up the podcasting business. Moderna, because they're leading the pack on developing coronavirus. By the way, those who are along Moderna, remember, there was a lot of other companies like Merck that came into play here. That's why it's down. Square, Shopify, which got hammered today because that's a stay-at-home play. It facilitates e-commerce. You get the picture. The worst performers, as I mentioned before, were generally recession stocks, the kind of names Wall Street loves when we're worried about a horrific economy, which you think it would be with 38 million people unemployed. As I said at the top of the show, the market's gotten more confident. We'll have a speedy V-shaped recovery. Witness today's terrific run. Boy, no one thought that 10 days ago. And that makes the recession stocks less attractive. So here's the big question. Is the Cramer COVID Index in danger of being left behind as America reopens for business? In the last couple of weeks, investors have been swapping out of the lockdown stocks and swapping into the beaten-down recovery plays. If that trend continues, and maybe it was near the end of it today because it was pretty vicious, then our index would be too defensive. But I got to tell you, I think it's too soon for it to give up on the recession stocks. As much as I hope we'll have a rapid recovery while America swiftly gets back to normal, it's tough to bet on. I'm worried the recovery will take longer than the bulls expect, and maybe a U, not a V. More importantly, there are just so many ways it can be derailed, particularly by the problems of the many small businesses that are currently on the government life support. We've been on a better trajectory with the virus, but if we see a bunch of big outbreaks as the economy reopens, well, that is going to hurt. If there's a second wave of infection, that's going to hurt. I know there hasn't been, and I am thrilled, okay? If there's any bad news on the vaccine front, that's really going to hurt. That's why I want to keep most of our defensive exposure. Don't want to get rid of it all. You need to be protected in case something goes wrong. That said, I think we can improve on the relevancy of the index. We have to tinker. Look, we put it together, 100 stocks. We have to tinker with it, make it better. Hey, listen, the S&P does that with its rebalancings. I am dropping 10 of the worst performers and replacing them with stocks that are better suited to this moment and more relevant. So we're going to drop Becton Dickinson, Digital Realty, Freshpet, Inovio Pharmaceuticals, Inseego, Kimberly-Clark, Next Year Energy, Owens & Minor. We had them on, Little Small, Roku, and Snap. Some of these are duplicative. You don't need both Becton Dickinson and Baxter when they're both underperforming. Hey, you don't need both Freshpet and Chewy. You don't need a not-so-hot vaccine play like Inovio when you've got a real good one like Moderna. 10 replacements. Okay, first I want Datadog. Don't laugh. They had the biggest beat of all tech companies. Biggest one. And then Splunk. Great number last week. These are two digital content performance monitoring and analytics plays that should have been in the index from the start. Companies need a flawless web presence right now, and these two make that possible, which is why they had such good quarters. Third is Twilio. It's doubled, I know. It's another cloud software play. Twilio helps app developers handle communications with their customers, and it's in fabulous shape. Another one that should have been in on the index from the get-go, but they had previous couple bad quarters, so I thought that there might be too much weakness. Fourth and fifth are e-commerce facilitators, Etsy and Wix.com. I think the future of small business belongs to sole proprietors operating on the internet. Etsy gives them a platform to sell their goods. Wix helps them build their better websites. They're both essential. Our bad for leaving these out. Hey, speaking of our bad for leaving something out, 6 is Chegg. On-demand, interconnected learning platform. When back-to-school season comes along, and I think it will, many colleges will keep holding classes online, and that's where Chegg comes in. They can help students and schools save a fortune. 7 is Target. This is an obvious retail survivor. Even though the stock got slammed when the company reported last week, I thought CEO Brian Cornell told a great story when we spoke to him on Thursday night. Target's a long-term winner here. The market is wrong, I think, on Target. And I know that's a tough thing to say. You're never supposed to say that. But I've been saying that about Target ever since Brian Cornell got in there. 8th edition is S&P Global. Doug Peterson makes most of its money as a ratings agency. There have been so many bond offerings lately that S&P's making a killing, as we know, when we had them on recently. 9th is Palo Alto. They were on last week. And, boy, they told a great story. With so many people working remotely, cybersecurity is on fire. Palo Alto is the industry leader now. It just reported a phenomenal quarter. Some would dispute that leadership, including CrowdStrike. But it was a good quarter from PANW. Finally, there's Emergent Biosolutions, which is a vaccine play, but it also has a contract manufacturing business, meaning whoever comes up with a COVID vaccine, they'll likely use Emergent to help manufacture, remember, J&J's partner. Bottom line, with those 10 changes, I'm feeling better about the Cramer Covid-19 Index. But this is a very big but. If the reopening goes smoothly and the economy comes roaring back, we're going to need to abandon the whole index and swap it to a totally different cohort of recovery stocks. See, I don't think we're there yet, although I'm working on a separate index so that we'll be ready when it happens. Let's go to Robert in Kansas. Robert.
Booyah, Jim.
Booyah, Robert. What's going on?
All right, so my question is about Dollar General, Jim. So knowing that Dollar General is a strong consumer defensive company to own during times of high unemployment and recessions, they have also beaten estimates consistently during 2019. Do you think there'll be estimates again Thursday? And is it time to buy some more Dollar General?
Here's what I'm going to tell you. When Dollar General reports, the stock tends to go down. I mean, I've seen it more than not go down like 4, 5, 6 points. And people, then Todd Vasos, who's the fabulous CEO, talks, and people realize, well, what am I doing? I threw it away. And new buyers come in. So why don't you wait to see the quarter? How about Rick in New Jersey? Rick.
Hi, Jim. It's Rick from New Jersey. My question is on British Petroleum, BP. I bought it at 22 when the oil prices were really low. Since then, the oil prices have more than doubled, and yet the oil stocks, all of them, are still down. What do you think?
Nobody believes And that's usually pretty good when nobody believes, except for Chevron, I believe there. Like, for instance, people tell me that BP is going to cut its dividend. They just raise the dividend. But I'm not a proselytizer for the oil stocks. When people ask me what to buy, I always say you can buy Parsley, you can buy Pioneer, you can buy Diamondback, you can buy EOG, or you can buy Chevron. There. That's my complete list. Don't deviate. All right, I'm feeling pretty good about the updated Cramer Covid-19 Index. But if the economy comes roaring back and we get the V, well, look, what can I tell you? This is anti-V, all right? I like a barbell. You heard me say that at the top of the show. Now, there's much more Mad Money ahead. Can Intuit ride out the COVID-19 economic shock? I'm sitting down with the CEO after earnings to see how the company's doing. I've loved that company for a long time. Then COVID-19 impacts everything, including the Farm Bill. I'm talking to the CEO of Corteva. Yes, that's that DuPont Dow spinoff. Find out how he's positioning himself. And Oil Calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.